that we've already had two very strong years in the market. We came into 2025 off the back of 20% plus gains in the previous 2 years. You would not have expected to have had a third in a row. And I think you're right that the longer it goes on, the more people feel like it's just too painful not to be exposed to those gains. Yeah. No one wants to miss out on that, which of course is always true at the top of the market.
Hello, everyone, and welcome back to the podcast. I'm here with Tom Stevenson, Investment Director here at Fidelity. And we're going to be answering your questions today. It's something that we do every few months, timed to accompany the publication of our investment outlook, the latest edition of which is out this week. We've received more than 100 questions in the past few days. We wish that we could answer them all, but time dictates that we have to narrow it down a bit. So we're going to be focusing on the 6 most pressing questions that we can see are on the minds of investors. These are the topics that dominated the questions that we received this time. Before we get into it, I will just say that if you find this video useful or interesting, to please subscribe to the channel, give us a like, join the discussion in the comments. It really does help people find what we're doing here, and it means that you're going to get updated content as soon as it is released. That said, Tom, welcome along. Let's get into these questions, shall we? I said it in the intro, but I'll say it again. We've got so many questions. It's difficult to answer them all. And what we've tried to do is pick out ones which are sort of representative and speak to a larger issue, and that kind of expressed in nice broad terms to open up that discussion. So if you're watching and you haven't had your question read out, that's our excuse. But the first question, Tom, is this, representative of a huge number that we received. Why is everybody predicting a strong market correction? Only because stock markets are at their highest, or are there fundamental economic reasons for this forecast?
Right. Okay. Well, I love this question because there's an absolutely massive assumption baked into the question, which is that everyone is predicting a stock market correction, which is probably not true, because if it were true, then the stock market would not be soaring as it is. So I think, but clearly, I understand the question. You know, some people are getting very anxious about the level of the stock market, and you know, for some good reasons. So let's explore what some of those might be. I mean, part of the question was: is it just because the market's big, the bull market's been going on a long time, or is it a new high?
Because
or something?
Exactly.
Yeah, I mean, and that's a really good reason not to worry about the end of a bull market, because the nature of markets is that they go up over time. And I saw some really interesting figures on this, and we may have mentioned this on a previous pod actually, that the stock market is at an all-time high maybe a third of the time over the last 100 years. A third of months over that 100-year period have included a new high for the stock market. So the fact that the market is at a new high is in and of itself not a reason to be concerned. The length of the bull market is a bit more to be concerned about, because arguably, you know, share prices have been rising really ever since the financial crisis, which is 16 years ago, and you know, bull markets have gone on longer, but not a lot longer. The fundamental reasons, I mean, bull markets don't just die; they tend to be killed. You know, is the sort of the conventional wisdom about them, and what that means is that something happens. There's a recession, or interest rates are jacked up because inflation becomes a concern, and that, you know, makes borrowing more expensive, and that then causes a recession. So I think in the absence of a recession, it's quite unusual for a bull market to end. Are we facing a recession? Well, you look at the data out of the US, the labour market is weakening, you know, but it's still pretty strong. You look at the other fundamentals that drive stock markets. Corporate earnings still growing pretty strongly. We're about to go into earnings season. Expectation is sort of high single digits growth in earnings, so that's not really a worry. Valuations is the remaining variable here. Some markets are quite expensive. The US market is expensive. Historically, it's not at its most expensive. It was more expensive in the dot-com bubble 25 years ago. Other markets around the world, I mean, look at our market here. You know, but not just the UK, Europe, Japan, emerging markets, the current valuation of the market is sort of bang in the middle of the range, the long-term 20-year or so range. So I don't think valuation is a major concern other than in the US.
Yeah. And just to kind of come back on some of these points. So yes, everyone predicting a stock market correction, not everyone clearly, as you say, but I think it's fair to say there's a growing kind of awareness of the high valuation, of the length of the bull market.
Yep.
We entered this year with people saying things look quite high, valuations look quite high. We had the whole tariff announcement period with apparently the market very, very, determined to jump on that as bad news. That's only been partially reversed. In fact, it hasn't been completely reversed at all, has it, the tariffs? And the market's just soared back up to new highs. And I think that's confounding a lot of people. The gains that the market have made over the past 2-3 years have been so good. I think a lot of people are like, well, I have to stay in. I don't want to miss another 20% year.
That's exactly right.
And so there's a kind of duality at the moment. If I, it's sort of odd. Like I kind of maybe know or expect something bad to happen, but I'm going to be in it until that happens. I think there's a lot of people looking at it that way. And then in terms of the economy, where perhaps people should, continue to be a bit more bullish, I kind of agree with you. There are signs of weakness. We're going to see probably a little bit of inflation as a result of tariffs in the US, weakening jobs, sort of, kind of coming in under target rather than properly weak. But the Fed's got room to move, isn't it? It's going to move. It's going to lower rates, and that's going to add some momentum to the economy, you would think, and it will do that, especially if growth is weak.
Yeah. I didn't mention interest rates, so I'm glad you did, because there is clearly political pressure on the Federal Reserve to keep interest rates lower, maybe lower than they really should be. And that is an argument actually for remaining exposed to the stock market, because artificially low interest rates provide a tailwind for the stock market. So if that's what we get, I agree with all of the points you made, and particularly the point about the fact that we've already had 2 very strong years in the market. We came into 2025 off the back of 20% plus gains in the previous 2 years. You would not have expected to have had a third in a row. And I think you're right that the longer it goes on, the more people feel like it's just too painful not to be exposed to those gains. Yeah. No one wants to miss out on that, which of course is always true at the top of the market.
Yes. Okay. Well, let's move on, because we'll probably return to some of these issues in other answers. The next question, Tom, is this. How is it when just about everything in the UK seems to be going wrong, with no prospect of anything changing, that the FTSE goes from strength to strength? So, more assumptions to deal with.
Yeah. Well, I mean, that one's not such a wild assumption, because I think it's fair to say that quite a lot is going wrong in the UK at the moment, and we are, coming up to what's going to be a very difficult budget in about 6 or 7 weeks time. But the answer to the question, I think, is twofold. One is that the UK stock market is only partially a reflection of what goes on in the UK economy. We've talked about this many times. It's a global, international facing stock market. It's driven by factors well beyond what's going on the UK high street or the UK government or whatever. And the other reason I think why the UK stock market is doing well is because it's cheap. We mentioned the valuations. A lot of people look at UK shares and think they're pretty good value, and not just stock market investors, but businesses as well. I mean, a lot of UK companies are being acquired by American companies in particular. Even though the stock market is at an all-time high, which it is, in valuation terms, it's not expensive.
Yeah. And this point about the UK being cheap, it's been that way for a long time. There's more and more headlines these days about why the UK is less attractive to list your company versus other jurisdictions. And that, again, that's not to do with the UK economy and being exposed to the strength of the or the weakness of the UK consumer, anything like that. It's to do with the UK as an environment for sort of the corporate environment, I suppose you could say. How much of that will or can be changed and reversed? How much of it is just a sort of, a UK kind of the UK being out of fashion and just a sort of just an impression that is out there that the UK is not the best place to list your company?
Yeah, I mean, I think it's hard to change, and I think the government has woken up to the fact that it probably needs to do something about it. The reality, though, is that the UK used to have a very big buyer of UK assets. The pension funds in particular held, maybe 40%. Going back not that long, actually, a few years ago, pension funds held about 40% of their assets in UK shares, and it's now down in the single digits. So we've had this persistent drip of money being pulled out of the UK market and redirected into global markets in particular. It's hard to see what will necessarily change on that front. And that is one of the explanations for why the UK market has become so cheap.
Okay. Well, let's move on for now, Tom. The next question is this. A little related to the first question, I guess. A nice simple one. Is the AI bubble about to burst?
Right. Okay. So yeah. So I mentioned, some of the reasons why stock markets have been riding high. Earnings growth is still strong. Monetary policy is supportive. Valuations are, in many cases not too bad. The fourth element, though, which I didn't mention because I knew that we had an AI question coming up, so I was holding back. The fourth element is that we have a fundamentally strong growth narrative around artificial intelligence, AI. So this is the equivalent of what drove the dot-com bubble 25 years ago for internet, read AI. The thing about AI is you can argue it both ways. You can argue it as being a completely transformative technology that is going to change completely the productive capability of the global economy, and therefore, that is an argument for investing in all of these AI-related stocks. The other argument is that a huge amount of money is being thrown at this perceived opportunity, much of which, as with all big technological revolutions in the past, whether it's the railways or air travel, or lots of money was thrown and is wasted. And I think when people say there's going to be a collapse of the AI bubble, I think what they're saying is that all the money that's being invested, literally trillions of dollars, is not going to generate a meaningful return. And I think, I understand that. And I also understand that, when you look at what AI is being used for at the moment, most of it is pretty sort of trivial, create a picture of my cat riding a horse. There's lots of meaningless stuff that AI is being used for. But I suspect that AI is going to transform the global economy, but in ways that we don't quite understand. And I think it's going to transform the economy in rather boring ways that just make companies a bit more efficient and therefore more profitable. But they don't make a great story. And so, both can be true at the same time. A lot of money will be wasted, but, not necessarily going to bring the economy down because it's being spent by companies which already have a lot of spare cash. And yes, I think at the same time, it is going to be transformative.
And the questioner says, is the bubble about to burst? I think probably a few things would have to happen. Let's separate the technology, which can be transformative, with what the stock market performance of AI exposed companies. For that to burst, probably, were it to be the case that lots of companies started saying, do you know what, we're halting our spending on AI. We haven't seen the returns on investment, and we're gonna batten down the hatches. We're not going to spend on AI. That would be a big shock to the narrative around AI.
Yeah.
it feeds into everything that we've said around recession as well, because that's more likely, or perhaps only likely, to happen in the case of recession, and companies saying, well, do you know what, now's not the time to be spending
well, and arguably it could cause a recession, because a high proportion of the money that's being invested in the economy at the moment is AI related. And if that money was withdrawn, or even partially withdrawn, an already slightly fragile economy might become more fragile.
Yeah, so like this bigger picture, this question and the question about stock market crashes and corrections and all the rest of it, it's hard to see how we get from, here today and then tomorrow a crash, but you can get there in stages. You could get there with slightly weaker growth, slightly, more uncertainty around investment on AI. Those valuations look toppy. People start pulling back. Lots of people who have had these great runs, like, hang on a minute, I was expecting this, I'm pulling money out. It's all a shift in momentum. It doesn't feel like it's close with, particularly, but
and an important point to make, which was actually made to me earlier on this morning, actually, where someone was saying the difference between now and the .com bubble was that, a lot of our pension investments are tied up in these AI stories. I mean, they are such big companies now, in a way that, yes, some of those .com companies were big, but they didn't dominate the stock market in the way that, this handful of the hyperscalers, the Nvidias and the Microsofts, etc., dominate the stock market. If there is a change of heart, it's going to be really noticeable.
Yes. Okay. Well, let's move on for now, Tom. Another negative one. I'm very sorry to say, Tom. Many of the scare articles in the media about how the government plans to fill the black hole in public finances seem to target older savers. So how is this budget really likely to affect pensioners? We have a budget in
26th of November.
26th of November.
Yeah, so a few weeks' time. It's a really good question, and at the heart of the question is a government which is strapped for cash. It's like governments all around the world. It is finding it politically unacceptable to cut spending, and it's finding it very difficult to raise taxes as well. So it has effectively a hole to fill. It's got to do it somehow. So you look around at where the government spends its money, and you look at pensions, for example, and the government spends an awful lot of money incentivizing people to save for their pensions. I mean, the latest figure I saw was something like 50 billion pounds a year in terms of the cost of the contributions, tax relief on contributions, netting off the income tax that people pay when they start drawing their pensions. The total cost is about 50 billion pounds a year. That is a lot of money. And so you can see why a government would want to target those. And that's why so much of the speculation is around things like the tax-free lump sum. You can take 25% of your pension out tax-free currently.
Up to a limit of about 268 grand.
268,000.
675?
Yes, thank you.
Something like that.
Yeah, that's right. I mean, when the government got rid of the lifetime allowance, which was 1,070,000 approximately, they kept 25% of that as being the cap for what you could take out tax free. So that's one thing that's possible to target.
Lots of noise around that issue, actually, in particular.
Yeah,
and lots of people who might feel they need to act around that. We should probably caution around that. No one knows what's about to happen with any of these allowances, and you should be always wary of making some kind of change in anticipation of a tax rule changing.
This is an irreversible decision.
Yeah.
If you take your money out, if you take your tax-free money out, you can't put it back in again.
Yeah.
And I think people do need to be very careful. Before the last budget a year ago, there was an upsurge in people doing that, and of course nothing happened. So I totally agree with that sentiment.
Yes, and the question asks about targeting older savers. it's a hard one. I mean, very often the things that target older savers actually target all savers. You know, if you're going to do something to make pensions less generous on tax relief or on tax-free cash, a lot of younger savers will be annoyed by that because that's what they're heading into in a few years. There's lots of things to say about this. Were significant changes like that to be made, it would clearly be highly controversial. It would make pensions less attractive when we know there's a chronic under savings problem. You talked about the cost of tax relief. A lot of that cost, a disproportionate amount of that cost, accrues to the public sector and to defined benefit pensions, which is a very difficult, politically difficult, tricky place for the government to target.
But two-thirds of those of that cost accrues to higher rate taxpayers.
That's true.
And that, of course, is politically, expedient.
Yes, correct. So it won't be an easy thing for them to do. And let's remember that one of the problems this government has had is that it's found it very, very difficult, either because it's made promises or it's being held accountable by its own sort of side. It's finding it hard to cut anywhere, and it's finding it hard to make. So it's not going to raise the main taxes, except through things like fiscal drag and freezing thresholds. But that's why lots of the other personal taxes are now kind of in the crosshairs because well, they're the ones that haven't been safeguarded. And it's tried to cut the winter fuel allowance, and it wasn't able to do that. It's made a commitment around the triple lock. These are all things that are benefit older pensioners at least. So it's not a kind of black and white picture here.
And it's not that the government is targeting older people. It's just that they're going where the money is. And if you identified that there's a big cost to supporting the pensions regime, and you decide to go after it, that is going to necessarily target older and wealthier people.
Yes, it is. So is it really going to affect pensioners? We don't know, do we? I suppose that's the short answer to that. We don't know on that one. But I'm going to say again, these big changes tend not to be made retrospectively. It would be, again, we don't know what politicians are going to do, but it would really offend, I think, basic principles of fairness for people to have organised their finances under one set of rules, planned their income in retirement, which is what the rules require you to do. Really, it's a long-term thing, planning your pension income. You've got to kind of set it out a long time in advance. If those plans are then completely changed by some retrospective change, that would be highly disruptive.
Disruptive and politically, not very sensible. I mean, the government may well say that that their preoccupation, what they're focused on, is fixing the economy, creating growth, and blah blah blah, all of those good things. Ultimately, what political parties are really in the business of is getting re-elected, and to do something as controversial and as damaging as that, they'd want to think long and hard before they really did that. But who knows?
Who knows, indeed. Okay, well, and the next question is the penultimate question, Tom, and actually slightly better news for pensioners. This one reflects. Given stock market uncertainty, Tom, what's your view on current annuity prices? Is it better to receive a higher fixed income in the earlier years when you're more active, or to get 3% escalation on your annuity? They go on to say the state pension would compensate for some of the decline in purchasing power due to inflation.
Right.
So just explain that a bit, what they're getting at there.
Okay, that's another great question. Well, the short answer to the first part of the question is, what do I think about annuity rates at the moment? They're very good. And the reason why they're very good is because longer maturity bond yields are relatively high, and we probably haven't got time to go into the reasons for that, but because bond yields are high, the insurance companies which basically sell you an annuity are able to sell you a more attractive rate of return. So I did actually look before I came down, and a healthy 65-year-old at the moment can get something like 7.5%. So
on their money, pretty good.
So £7,500 on £100,000 purchase price for an annuity, that is pretty attractive. to tie it into the question, though, were you to get a 3% inflationary escalation on that, you'd have to settle for 5.8%, I think.
So the difference there is you take that lower amount in the first place, but then that's going to rise by 3% every year. You don't know what inflation is going to be, but that's your guess around that.
You don't know what inflation is going to be, and you don't know how long you're going to last for. So those are two variables there. And then another thing that you need to consider here is the shape of your spending pattern through your retirement, which is a very interesting question, because, as I think the question alludes to, many of us would like to think that we'd want to do lots of stuff when we're young and reasonably able in our early retirement. And so maybe to weight the income and the spending to those early years and maybe spend a bit less. But then, of course, you don't know what your care requirements are going to be later in life. So planning the trajectory of your spending through retirement is not easy, and it's a big difference as well. I mean, the difference between 7.5% and 5.8% is a significant amount of money
every single year. That's the difference, absolutely. And I've heard this put forward anecdotally as well. People saying, well, actually, your spending needs probably decrease as your retirement goes on. What you're spending at 65 to 70 versus 85 to 90, probably a lot less as you're older, notwithstanding care costs, which are sort of a different thing. And it would seem that just allowing your income to be eroded by inflation, which of course offends every sort of instinct we have, because that's what you don't want to be doing, and that feels very painful.
But it's one way of doing it.
It could work for you there. So you're going to get the same amount. You're going to get your £7,500 at 65, and you're still going to be getting that £7,500 in maybe 20 years.
It's just worthless.
It's worthless. So inflation has kind of done its job there. I don't know the answer to that really, but it highlights the question, and it shows that people are really thinking about this challenge. Lots of clever, well-paid people are thinking about this challenge, and no one's nailed this, have they? It's
and the reason why is interesting. People are having to think about this in a way that they never had to before, because in the old days when most people benefited from an inflation-linked final salary pension, that was just not a question that you ever had to think about. It just automatically went up. Now you actually have to make an active choice to have that escalation or not. It's a great question.
It is. And it takes us to our final question for today, Tom. What is the rationale for gold increasing 50% in 2025? And will this rationale continue in 2026?
Well, yeah, I mean, so another good question, which highlights, far and away, the best performing sort of mainstream investment asset so far this year has been gold, up by about 47%, I think, in the first 9 months of the year, which even in a good year for stock markets is pretty amazing performance. Gold has, it's hitting new highs, sort of, almost daily. It's more than doubled in the last 3 years. It's really on a tear, and there are lots of reasons for it. Gold is perceived to be a safe haven. People gravitate towards investing in gold when they're worried about what's going on in the world. It's helped by falling interest rates, doesn't pay an income, so lower interest rates mean there's less incentive not to hold gold. There are some pretty big cost insensitive buyers out there. Central banks are buying a lot of gold and have done for many years to diversify their reserves away from the US dollar. There is a sort of de-dollarization of assets around the world going on at the moment. That's helping gold. And then more recently, and I think this is what's got everyone talking about gold recently, is more recently sort of ordinary investors, people like you and I, are looking at what's happening in the gold market and thinking, I wish I had more gold. And so the amount of money that's piling into gold exchange traded funds, for example, is at record levels. I mean, in the first 9 months of this year, I think something like $60 billion has gone into gold exchange traded funds. That is a record for a calendar year, let alone a 9-month period. So there's a real weight of money going into gold.
Yeah, and the fact that performance has coincided with a great period for stock markets as well is interesting, because the sort of base case for gold is as a diversifier. Well, it hasn't been diversified away from stock markets, which is great if you own both those assets, but it hasn't been diversified. And it reminds, I think, that whatever the case for gold as a hedge, it's always overtaken by shorter term considerations in the market, like you say, about the liquidity of buyers out there and the other demands questions that come up. It's over the long term, it might do its job against hedging against inflation, and clearly is now. But it's difficult to come up with a kind of a method to explain what's going on.
It is, and it's very difficult to really put a sensible valuation on gold. The one thing I would say about I think there was part of the question was, is it likely to continue?
Yeah.
Who knows? But I looked this week. I was reminded of what happened in the 1970s, because gold spiked higher in the 1970s. It tends to be very gappy. It tends to shoot up and then go nowhere for a long time. Between 1976 and 1980, the price of gold rose sevenfold. In 4 years, 7 times it went up in just a 4-year period. So the fact that gold has doubled in the last 3 years is, historically speaking, not unusual.
Yeah. Okay. Well, Tom, that is all the time we have for now. A full copy of Tom's investment outlook is available to download at fidelity.co.uk/outlook. Thank you so much for watching. And Tom, thanks for joining me.
Thanks very much, Ed.